Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Foshan Haitian Flavouring and Food Company Limited Annual Report. Foshan Haitian Flavouring and Food Company Limited offers a diverse range of products and services that cater to the food industry. At its core, the company is involved in the production and sale of condiments, including soybean paste, soy sauce, flavored sauce, oyster sauce, vinegar, cooking wine, and compound seasonings. In addition to these staple products, the company also provides packaging materials and glass bottles for various industries. Furthermore, it offers catering services, which suggests a focus on providing comprehensive solutions to its clients. The company's extensive product line is not limited to domestic sales. It exports its products worldwide, solidifying its position as a global player in the food industry. The company's long history, dating back to 1955, and its headquarters in Foshan, China, underscore its commitment to serving the local market while also expanding its reach globally. As a subsidiary of Guangdong Haitian Group Co., Limited, Foshan Haitian Flavouring and Food Company Limited benefits from the resources and expertise of its parent company, enabling it to maintain a strong presence in the industry. In summary, Foshan Haitian Flavouring and Food Company Limited's business operations encompass product manufacturing, packaging services, catering solutions, and international trade. Its extensive range of products and services positions it as a key player in the global food industry. Foshan Haitian Flavouring and Food Company Limited market capitalization of $277 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that Foshan Haitian Flavouring and Food Company Limited holds a significant advantage in their industry. Foshan Haitian Flavouring and Food Company Limited trades at a higher price-to-earnings ratio of 27 times and a higher price-to-book ratio of 4.7 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 20% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.15%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for a company can be attributed to several key areas. Firstly, the sales of flavoring products have shown significant increases in both 2024 and 2025, with a notable jump of plus 159,718 in 2024. Additionally, transportation services have also seen substantial growth, with an increase of plus 114,844 in 2024. Furthermore, interest income has experienced a 10% rise in 2025, contributing to the overall revenue growth. On the other hand, certain factors have led to revenue decline. A notable decrease in contract liabilities due to recognizing revenue during the year has resulted in a loss of minus 67,076 in 2025. Moreover, sales rebates have also had an impact on revenue, with a charge of minus 64,949 in 2024. Business combinations have also contributed to revenue decline, resulting in a loss of minus 67,076 in 2025. The company's diversified customer base and contracts with original expected duration within 1 year or less suggest that the revenue growth is not solely dependent on a few large customers. However, the inherent risk of inaccurate revenue recognition due to sales to distributors identified as a key audit matter may pose a challenge to the company's financial performance. The net income of the company experienced an increase over the period under review. Specifically, it rose by 16.9% to RM 11,365.8 million in one instance, and by 10.9% to RM B 7,045.5 million in another. This growth in net income is a positive indicator of the company's financial health. However, the profit margins tell a more complex story. The gross profit margin increased by 3.3 percentage points to 39.4%, while the net profit margin rose by 0.8 percentage point to 24.4%. On the other hand, there is inconsistent information regarding the change in gross profit margin, with one page indicating a decrease of 10-15% and another page suggesting a decline of 4.68%. Despite this inconsistency, it appears that the company's profit margins have generally improved over the period under review. The company's financial performance indicates a positive trend in its operating cash flow. The data from various pages of the report confirms this assertion. On page 53, it is stated that the company generated RMB 7,746 million in cash from operating activities. This figure is further supported by page 161, which shows net cash generated from operating activities to be RMB 7,745,951 in 2025 and RMB 6,840,202 in 2024. The data on page 236 also highlights the company's ability to generate significant cash from operations. In 2025, the company generated RMB 9,147,784 in cash from operations, while in 2024 it was RMB 7,818,291. Although there is a discrepancy between these figures and the one on page 53, they all point to a positive operating cash flow. However, page 269 presents a different figure for total operating cash flow, which is RMB 3,829,243. This could be due to differences in accounting methods or other factors that affect cash flow calculations. Nevertheless, when considering the overall trend and data from various pages, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has seen a significant increase from 2024 to 2025. The total debt level rose from RMB 10,199,512 in 2024 to RMB 20,925,379 in 2025, indicating a substantial growth of approximately RMB 10,725,867. Additionally, the company's restricted cash increased by plus 38.6%, and total liabilities also saw an increase from RMB 9,479,054 to RMB 10,344,267. In terms of interest expenses, there was a moderate increase. The interest on bank loans and other borrowings rose by RMB 341, while the total finance costs increased by RMB 1559, 6.5%. Furthermore, interest expenses also saw an increase of plus 1,242 from RMB 21,818 to RMB 23,060. These changes suggest that the company's debt level has grown significantly, but its interest expenses have not seen a substantial rise. Management's outlook on the company's strategy is centered around driving growth through technological innovation. They aim to expand their offerings by providing full-scenario cooking solutions and investing in research and development (R&D) to stay ahead of the competition. The company plans to focus on internationalization, leveraging its global presence with subsidiaries in various jurisdictions. A key aspect of management's strategy is promoting consumption through innovative products, enhancing adaptability of consumer goods supply and demand, and fostering breakthroughs in the food sector. This approach will enable the company to tap into the immense growth potential of the condiments industry. To achieve this, they plan to invest heavily in technological innovation capabilities and product innovation capabilities. Management has also committed to a 3-year dividend plan, with an annual payout ratio of no less than 80% of net profit from 2025-2027. This move demonstrates their commitment to returning value to shareholders while continuing to drive growth through strategic investments. The company's focus on partnerships will also play a crucial role in achieving mutual growth of corporate performance and social value. Overall, management's strategy is built around driving innovation, expanding globally, and fostering growth through strategic investments and partnerships. The company's financial activities have been marked by a commitment to shareholder value creation. One notable aspect of this is the payment of dividends. As stated in the summary, the company has indeed paid dividends, with a specific proposal outlined for the 2025 final dividend distribution. This demonstrates a clear intention to return value to shareholders. In addition to dividend payments, the company has also engaged in share buybacks. Although information on this activity is limited, it is confirmed that shares were bought back through the overallotment option on July 16, 2025. This action further underscores the company's focus on enhancing shareholder wealth. The company is facing potential concerns regarding its inventory buildup and supply chain disruption. On page 31, it is noted that revenue growth of plus 14.6% for specialty condiment products may lead to inventory buildup. This suggests that the company's sales are increasing at a rapid pace, potentially resulting in an accumulation of unsold goods. Furthermore, on page 56, there is a mention of possible supply chain disruption due to raw material price fluctuations. This indicates that the company's supply chain may be vulnerable to disruptions caused by changes in raw material prices, which could impact its ability to produce and deliver products efficiently. That concludes the financial summary for Foshan Haitian Flavouring and Food Company Limited. Feel free to comment below, and I will be happy to answer them when possible.